A big week is behind us with US data pointing towards easing fears of a recession in the US. We've seen Japan announcing that they're going to have a new PM, which certainly sparked a surge in terms of the Japanese yen. We've seen massive upside in terms of Asian markets off the back of a whole raft of stimulus measures, with China seemingly turning the tide on the idea that they're not serious about getting themselves out of the quagmire that they've been in for years now. And central bank decisions, with the SNB cutting rates as expected, the RBA keeping rates steady as expected. But we move into a new week and we've still got plenty to look out for, as the beginning of October brings employment data from the US. Of course, we've also got inflation data from the eurozone following a sharp decline in terms of both French and Spanish CPI on Friday. And we've got an announcement from OPEC coming in the wake of recent rumors that we are likely to see Saudi Arabia essentially abort the plans to prop up prices and move them towards $100 and instead push back to try and regain market share. Will that drive further downside in terms of energy markets? Well, let's get into it with the latest episode of the week ahead for the week starting Monday, the 30th of September. So let's get into it. First and foremost, here's the big picture in terms of some of the top ticket items that we've got on Trading Economics. These are attributed to being the sort of highest value items to be watching out for, but we'll go into some of these in detail. First and foremost, we kick off on Monday with PMI numbers coming out of China. They've highlighted both manufacturing figures from the headline number and the Caixin numbers. We've also got the services readings, but certainly Chinese manufacturing is going to be absolutely key. Inflation from Germany, we've got Chairman Powell, Fed Chair Powell speaking as well. So a busy Monday. Tuesday, consumer confidence out of Japan, inflation out of the eurozone, the ISM manufacturing PMI, that's going to be massive. We'll talk about that. The JOLTS job openings kicks off the focus on job numbers in the US. We've also got the likes of unemployment claims. We've got the ADP number coming out. And then we wrap up the week essentially with the jobs report with payrolls, unemployment rate, average earnings, and alike. Bear in mind, we've also got that ISM services PMI. So a lot of US stuff going on. So that's probably the smart place to kick off, really. We can see a few different things that you should really be looking out for. First and foremost, I would say that ISM manufacturing PMI figure on Tuesday. Bear in mind the previous figures at 47.2, and each time that we see this reported over the past 2 months, we've seen significant risk of moves coming into play because people are surprised at just how weak the manufacturing sector is over in the US. It generally points towards weak employment, and generally the inflation side of it, so the prices metric, remains elevated. So, it's a worst case scenario, really. High inflation and low economic growth and output. Certainly not what we want to see. But it's worth bearing in mind that the manufacturing sector is not the mainstay of the US economy. That is the services sector. And as we could see in the sort of bottom section on Thursday, we've got that at 51.5, expected to drop, but still remain well within expansion territory. Notably, the prices element, so the inflation element, very elevated when it comes to the services PMI number. But certainly coming off the back of the recent core PCE metric, the CPI number, by and large, I think inflation is likely to stay in the mid-twos for the time being, and we're going to see it get back down to target in the first quarter or first half of next year. So, it's a question mark about whether the inflation thing is an issue. It's just whether we see a surge in inflation or not. And at the moment, we're not necessarily seeing that. So the question mark here is, with the fact that the Federal Reserve remain data dependent and markets are essentially pricing the interest rate trajectory based on the direction of travel for the US economy, are we going to see something different from this data that points towards the need for a 50 basis point cut or points towards the potential for a recession coming around the corner? Well, further downside for the ISM PMI might do that, but we're expecting to see it rise to 48.3. So that would be a positive, quite frankly. The JOLTS job openings numbers worth watching out for as well. That's the sort of first of the different employment readings that we're going to be seeing over the course of the week. But really, it's going to be the ISM numbers and then Friday's jobs report. The forecast is a weaker payrolls number at 130K. Unemployment rate crucially expected to tick up to 4.3. Of course, if you remember, it went 4.1 up to 4.3. Then it moved back down to 4.2. We're expecting to see it move higher once again. And this is a key one. And a lot of the time, people don't really care that much about unemployment rate because it just stays static. So they really focus on the payrolls number because we see volatility in that. But recently, there has, of course, been this big focus on the potential for the unemployment rate to surge and signal an impending recession. So if we do see upside in terms of unemployment, it could possibly be a cause for concern. It could push them towards a 50 basis point cut in November rather than a 25. Average hourly earnings, of course, also crucial. A reading of 0.1 expected and a decline to 3.2%. And so when we're talking about inflationary pressures, yes, you can look at the prices element of these ISM services and manufacturing PMIs, but also look towards the average hourly earnings figure, because a decline down from 3.8 to 3.2 really does allay some of the fears around underlying wage pressures in the US. This shows you the ISM manufacturing versus services PMI. So as we can see, manufacturing has remained in contraction, aside from one sort of tick higher over the course of the last couple of years, right? So weakness in manufacturing is not necessarily something new, and we haven't been in a recession during that entire period. So to say, you know, wow, we've got a really poor ISM manufacturing PMI, we're going to see a recession, that just doesn't make sense. What we would need to see is services to drop down into recessionary territory or to drop below that 50 mark. And as you can see, back in 2019, we saw that recession, we saw that collapse around the sort of COVID pandemic. So, you know, if we see that ISM services number dropped at below 50, then it's cause for concern. Until that happens, it really doesn't necessarily signal an impending recession. Here's the sort of overview of the US jobs market. Bear in mind, I will do a separate video looking into the US jobs report because it will take longer than trying to throw it in the middle of this video, where, of course, we tried to cover quite a lot. Notably, you can see unemployment rate seemingly having based out, but we haven't really seen it sort of reach sort of any sort of significant trajectory that might point towards a major surge. In terms of payrolls, yes, we've seen it on a downward trajectory, but it's sort of coming back towards what might be relatively normal. You know, it's a bit weak at the moment, but it's probably to be expected. You know, we have seen a number of different elements within the US economy that has shown signs of weakness. It doesn't necessarily mean a hard landing, because bear in mind, a soft landing means softness, right? So we're seeing softness within the US economy. We're not necessarily seeing a recession right now. And we'd need to see, you know, sharp declines in terms of payrolls, a sharp rise in terms of unemployment rate, things like that. We're not necessarily seeing that at the moment, but certainly both of them are moving in the wrong trajectory. But as long as it does that, but only very steadily, and doesn't necessarily see a capitulation, then it has the benefit of pushing the Federal Reserve into another 50 basis point cut in November. Average hourly earnings, of course, drifting towards the downside. Participation rate pretty much back at relatively normal levels. Now, here's the expectation according to the FedWatch tool from the CME. And we've seen quite a lot of movement recently, quite frankly, because a couple of days ago, I was looking at this and we were talking about 60 odd % chance that we're seeing a 50 basis point move. Now we've seen a move back in favor of a 25 basis point move. That's because we saw stronger than expected core durable goods. We saw a decline in terms of the unemployment claims, and we saw a relatively strong GDP reading of 3%. That is an annualized figure. But certainly all three of those taken together don't necessarily point towards this desperate need to suddenly cut 50 basis points every meeting. And the Federal Reserve did say, look, 50 basis points is how we're going to kick it off, but this is not the norm. Do not expect this to happen every time. So will they follow up with another? Well, market's pretty on the fence about this at the moment. In terms of a market to trade around this, I wanted to bring up cable. This is the weekly time frame, and in actual fact, I want to show you the monthly time frame because this highlights the wider context, right? 3 months of strong gains. So if we're looking for potential short positions, we're going against the trend of the past 3 months and arguably the trend over a longer period than that. But certainly this is consistent. We haven't even seen a single pullback within that. Daily time frame looks like this. So nice trend, but you're going to see pullbacks within the bullish trend that has been dominating over the last, what we're talking about, 5 months, something like that. right? So 5 or 6 months. So do we see that pullback coming into play here? Or do we see a continuation of this current leg that higher that we're trading within? We've seen a pullback here. If we're to look in terms of this recent trajectory, that's going to be a shallow 23.6. That's probably going to be a 61.8 fib. Let's see. I was like testing myself. It's part of the fun. So 76.4 actually. Right. Yeah. So deep retracement, shallow retracement, somewhere in the middle. That might be at 38.2. This is probably a 50 to 61.8. 61.8 it'll be. There you go, slap bang on a 61.8. And now we're in this current leg higher where, we've seen a rally into that prior high, a little bit of a pullback, probably likely to continue on this current vein. Look, if we break back below, considering we have tentatively broken through that resistance level, if we break back below this near-term swing low of 133, maybe that could point towards, like we're seeing here, the possibility of a retracement phase coming into play on this daily time frame. But until that happens, the bullish trend does still play out. And essentially what we're looking for here in terms of market movements is if we see weakness in terms of the US economy, that might point towards further downside in terms of the US dollar and therefore further upside in terms of the pound against the dollar. Now, the weakness that we're seeing here comes off the back of the strength that we've seen from the US economic data that's just come out in terms of the durable goods, the jobless claims and the GDP numbers. But we're starting to turn higher once again. And so really this sort of back and forth over whether we're going to see 50 or 25 basis points, it will significantly impact sentiment for the US dollar. But I would say from a wider perspective, we've seen a long protracted move lower over the period, in particular this period here, over the period where we're seeing strong demand for the US dollar over big concerns around the economy, whether that's COVID, whether that's inflation. And now we're coming on the backside of that, where we're seeing the prospect of stronger economics, the prospect of inflation being low and therefore rates being cut. And that should benefit assets that are not haven. So the US dollar should weaken off the back of that. Also, bear in mind that UK core CPI is very elevated. It's in the mid threes. So, you could see a little bit more of a cautious approach from the Bank of England going forward. And if you compare that to the US, where we're talking about the potential for another 50 basis point cut, then you start to see that divergence between rates that could also benefit cable. So near term, the trend still remains in play for me. 133, the support level to watch out for on this one. Next, let's talk about, let me get it up. The eurozone. So we've just closed out, or we're in the process of closing out a week that has ended with inflation data from France and from Spain. The French monthly inflation number for September was the lowest in 1990. It was minus 1.2, absolutely massive decline in a month. And that has driven the headline year-on-year number to 1.2, so well below that 2% mark. We've also seen a sharp decline in terms of the Spanish number. So both of those point towards a lower than expected figure for inflation, headline inflation in the eurozone. But actually, we're already starting to see that factored in. You can see here 1.5% the expectation, down from 2.2. So again, well below that 2% figure. We need to see the core number declining as well. There's an expectation that will come in at 2.7%. Of course, earlier in the week, we've also got on Monday the German numbers. That's expected to drop down to 1.5%. So significant below target inflation. And the question mark here is, are we going to see the ECB forced into a more rapid pace of easing? Well, markets are growing increasingly confident that we will see a rate cut at the next meeting, whereas previously there was an expectation they were going to hold off for October, in part because November is the next Fed meeting, right? So this is an additional meeting that you're seeing in between. So rather than getting ahead of themselves, they pretty much want to sort of keep pace with the Fed. But nonetheless, that might not happen. And certainly if we see this significant disinflation coming into fore, and if we see that core number declining, then really that could start to push the ECB into taking action earlier than perhaps they had planned to do so. In terms of the breakdown for eurozone inflation, you can see here that we've got the likes of the French number. The French number's actually not been updated here. So you can see Spanish 1.5%, the French number 1.8. That's not right. It should be 1.2. So they haven't actually updated the latest figure for this. Nonetheless, I went to try and find the data that highlights the different weightings for these different countries that go into the eurozone figure. And as you can see here, we've got 1, 2, 3, 4 countries. Between the four, that accounts for 70% of the eurozone metric. So, you know, before you see that eurozone number, you already see the vast majority of the figures that influence it. As you can see here, Germany is the heaviest weighting. So the number that we see on Monday out of Germany will significantly impact where we expect a eurozone number to go to. But certainly there's a strong chance that we see a strong move lower, but that's what markets are expecting anyway. You can see here in terms of the breakdown that we're seeing month on month. As you can see in the middle, 0.32 being stripped out from last September. The past couple of months have been particularly low, so that would point towards further disinflation. But, you know, we can't necessarily expect to see the same kind of month-on-month figures that we've seen over recent months, because if you're looking at the figures that we've seen out of Spain and France so far, then there's some really significant disinflation that we're in store for, if that's anything to go by. So certainly headline inflation isn't necessarily a problem. You know, the core figure is probably a little bit more of a problem, and it's probably likely that we're only really going to get back down to target next year. As you can see in the middle section, the right-hand side is absolutely massive, right? It's like 1.1, 0.7. These are monthly figures, right? So once we see them stripped out, all of a sudden you're seeing, you know, per month, you're seeing the potential for like 0.9 taken off of the core CPI reading. So there is probably a knowledge that, you know, if you wait long enough, you'll also see that core figure really coming down in a meaningful manner. The last few months, we've seen 0.33, minus 0.16, 0.35. So it's moderated somewhat. Certainly it was February, March, and April that were absolutely massive inflation metrics. So hopefully this will move in the right trajectory. It's probably not going to move much. As you can see here, September from last year, 0.23. That's what's being taken out. So, you know, maybe we could move a little bit lower, but we're at 2.8% at the moment. But certainly if we're at 2.8% at the moment, and you look at what's going to happen at the beginning of next year, certainly when February, March, and April are taken out, you know, this figure is going to be well below that 2% marker by that point. You know, so the ECB will be aware of it, despite the fact that we've seen this bumper period, and despite the fact that we're probably not going to see that much disinflation for the next 1, 2, 3, 4, 5 meetings or 5 announcements. We're probably going to see inflation either flat, move a tiny bit lower, or core inflation, or moving towards the upside. As you can see, that big negative reading for January, but they will be aware of what's going to happen when we move beyond that. Let me just bring up charting wise. I wanted to bring up, here we go. I wanted to bring up euro yen. Now, euro yen has taken a really significant hit, in part because of the inflation data that's come out of the eurozone from France and Spain. And that, of course, highlights the potential for further easing from the ECB. But it's also an interesting one to talk about, because we've just heard the news about the new prime minister that is impending over in Japan. And the fact of the matter is, he is not the kind of person that's really going to be backing the idea of continuously buying JGBs or easing off on the tightening of monetary policy. So his name's Shigeru Ishiba. Ishiba, I should get used to that name. So Ishiba essentially is likely to push on when it comes to measures that are likely going to strengthen the Japanese yen. That has happened at the same time as the Eurozone inflation data. And that's why we're seeing this really strong move towards the downside in terms of Euro yen. Now, we had seen this pretty significant rebound, but we didn't take out this prior peak here. Now, from a fib perspective, I don't even know why I'm drawing this. It's very clear that it's going to be well beyond any of these fib levels, because it came very close to that prior peak, as you can see here. But we didn't break through that resistance level. Now we've got this massive bearish engulfing candlestick formation. Of course, we have, with such a move, we have the potential for a bit of a rebound, but you can see very clearly we've got this trend in play here. I'm trying to think of where these lines might sort of tally up. There we go. So we've got trend line support here. very clearly broken. I think near-term gains are likely to be sold into, quite frankly, and certainly given the idea that we're going to see very weak inflation data out of Germany, out of the eurozone. I think that euro yen downtrend could kick in once again here. But the caveat is that we could see short-term some sort of respite, just given the sheer size of that move. We don't necessarily know how big that might be. So one way to potentially play this might be, let me just move this chart forward. One way this might work out, and this all comes down to sort of fib retracements or just the size of retracements, right? So if you see a deep retracement, it might come up here, so you could come back into trendline resistance and then come back in here. You'd be looking then at this as a sort of fib retracement and say, oh, okay, that's maybe a 61.8 retracement. Let's just get onto that. There you go, perfectly. So you could come into a deep fib retracement zone and then potentially start to see some candlestick formation that signals the bears coming back into play. And that's where you might be interested. You might see a shallow retracement because, of course, we never know how deep these retracements are going to be. Let's say it's a 23.6. Let's see the shallow. There you go. 23.6. So we're just beyond that. Let's say we're in this area. And then we start to sell off. So you don't necessarily know if that is going to subsequently move in this direction, right? And suddenly, so if you start shorting in this area, doesn't really make that much sense, quite frankly. So with this kind of movement, what I like to utilize is a breakdown through prior support, right? So if we break through there, then all of a sudden this looks like the kind of area where you've got confirmation that the retracement is over and the bears are back in charge. And the fact that you've seen a shallow retracement means that any area for stops or anything like that can be not necessarily too far away. So these are just ideas of how I like to play potential moves in the markets when I don't necessarily want to enter. I wouldn't enter here. There's different ways that this could play out, but we don't necessarily know exactly how it will play out. But I have an idea that I think that euro yen downtrend could be kicking back into play following this big collapse and the news over in Japan and the news over in the eurozone. So we'll see how it plays out, but certainly that's my view on the matter. And I think there's a good chance that we might see a bit of respite, but depending on how that sort of respite plays out, there's different ways that you can shape up trades for this market. So euro yen definitely going to be a really important one to be looking out for in the week ahead. And finally, I want to show you something that's not even on my chart, actually. So what I've got here is a bunch of data. All of it is relevant, but not necessarily the data that the event that we're talking about. And that is the OPEC Plus meeting scheduled according to Forex Factory on Wednesday. And this comes in a week that we're also going to see a host of other data points that will also impact oil prices. Now, oil, of course, has been hit hard, to say the least. The last 3 months seen very significant downside for oil. And the question mark is, are we going to see more, or is this an area where we might see the buyers come back into play? Well, first and foremost, we've got this big story about China, right? So a whole raft of stimulus measures over in China. And so we start talking about this potential resurgence in terms of Chinese manufacturing or Chinese growth or Chinese consumption. That might not happen, quite frankly. Right now, the moves we're seeing within markets are driven by sentiment because these policies haven't really started to happen or filtered through into the economy. So sentiment is one thing, the absolute data is another, and whether this is going to prop up demand for oil remains to be seen. But certainly if we were to see strong manufacturing PMI data on Monday, that could help bolster the idea of resurgence in terms of demand, because we continue to see weak demand from China when it comes to oil. And you're talking about the global picture also. Do we continue to see record production over in the US? Do we continue to see weakness in terms of the global outlook for growth? Well, of course, now we're seeing rate cuts coming into play. So we're potentially going to see a bit more of an optimistic outlook in terms of growth for the globe, or certainly for the West. Maybe not China at the moment, but the announcement we've seen over the last week should provide the basis for those sort of green shoots of recovery over in China. Wednesday, we've got the crude oil number. That comes off the back of this sharp decline, minus 4.47 million barrels. And that decline and collapse in terms of stockpiles in the US could provide the basis for people to become a little bit more bullish as well. That record production over in the US has actually stuttered somewhat. And so, are we going to see the Chinese stimulus providing the basis for a recovery in China, the stimulus from the central banks around the world, in particular in the West, providing the basis for a recovery in the US and Europe and New Zealand and you name it. So all of a sudden that demand picture starts to turn, and production over in the US has been sort of sideways. Really, we're seeing massive drawdowns in terms of crude oil inventories. So all of that points towards a possibility of strength in the oil market, but you'd be betting against the trend here. So that's not necessarily something I'm saying, I'm super bullish here. I'm just saying, there's a few things worth noting within this market. This came out over the course of the week just gone. Saudi Arabia ready to abandon a $100 crude target to take back market share. Essentially, they want to raise output and they want to start to earn more money, even at these current prices. Well, that was quite swiftly rebuffed. This is, according to Argus, they said that neither Saudi nor the wider OPEC group have any specific target for oil prices, and they are not about to abandon their oil output discipline in a push to get market share. Now, of course, we are still talking about a potential rise in terms of production at the back end of this year. It was delayed, but we're still expecting it in December. And so, what if Trump comes into power and starts saying they're going to push even more for US production to rise? And if we see that rise in terms of production over in OPEC, then the supply side of things is quite clear. And then if the demand doesn't really pick up, in particular in China, then again, you do have cause for concern for oil prices. Here's the production numbers and trajectory for 2024, which is the yellow line for OPEC plus. As you can see here, they have cut back on production from a historical perspective. However, in terms of exports, not too bad actually at this point in time. Out of this, compared to the past 4 years, you can see it's actually higher for August than 3 out of those 4. So out in terms of exports, hasn't necessarily impacted it that much. So that's worth noting. Here's that chart in terms of weekly US oil production. Yes, the trend is upwards. Yes, we saw record highs, but we haven't necessarily seen it continue to move higher, and we're starting to see it sort of pull back a little bit of late. So yeah, US production, of course, still elevated, but we're not seeing that continue to push up and up and up. And so, these different factors provide the backbone of any one looking into the price of oil. This is the chart for Brent crude. And as we can see here on the monthly time frame, we have declined back into this key support level of $70. That's the low that we have here in March 2023. The weekly time frame, we can see here that we've rebounded from that level. So let's just get these lows in. So we can see this big area of support that we haven't broken through, and then now we rebounded once again, but we're rolling over here. And so the question mark here is, do we break the $70 mark? Do we essentially clear it out? And all of a sudden we're in sort of clear air, really, following this big, I'd say it's sort of like a descending triangle, despite the fact that doesn't necessarily line up perfectly. Okay, you can look at it from that perspective, you could look at it from this perspective, different ways of, that's probably a little bit nicer. Either way, sort of descending triangle formation, and the breakthrough $70 would see the exit of that and a potential for another severe decline for this market. But we have a number of factors. We've seen, sharp declines in terms of crude inventories. We've seen all of these stimulus measures coming out of China. And if this OPEC meeting sees them push back on the idea that they're going to raise production and try and regain market share, then once again, that could lift prices. So we're at an absolutely key support level. We are rolling over back towards it, but perhaps that just creates a higher low and we start to base out here. Who knows? But certainly $70, that area is going to be absolutely critical in a week that does see manufacturing PMIs out of China, following a week that's seen stimulus from China, the crude inventories following that 4.5 million barrel decline last week, or the week just gone, and an OPEC meeting that hopefully should clarify their outlook in terms of production increases, following a week that has seen plenty of rumors in both directions. And certainly the ability to sort of clear that up would be welcome from the market. So I hope this has been useful for you guys. Good luck trading in the week ahead, and I'll be providing plenty of in-depth overviews for some of these particular events that I've covered within this video.